Hello, good morning. Welcome to the monthly debt outlook from Canara Robeco. Let's look at the geopolitics situation. The main event in November was the US presidential election, and in a landslide victory, Donald Trump won hands down while defeating Harris. Obviously, it was expected that the fight would be very narrow, but the way Donald Trump won shows that the policies by the Democrats were not in tune with the masses. Obviously, the market expectation from Donald Trump remains high. He is expected to cut corporate tax cuts, already talking about tariff increases on countries like China, Canada, and Mexico. And this could lead to higher fiscal as well. Rate markets reacted appropriately. We saw 10-year yields climb to 4.4% just before the elections, though they have now come down to around 4.2%. In the Middle East, things have quietened down a bit as Israel and Hezbollah, which is backed by Lebanon, have reached a ceasefire. There is also expectation that with Donald Trump coming in as the president, they will try to settle the Ukraine-Russia war also very soon. Now there are a lot of chatter around the world about how to reach a compromise between Ukraine and Russia. This has been positive for oil prices. Oil prices have been on the downtrend for the last couple of weeks. Brent price is around $72 from the highs 82, which was seen when last time Iran attacked Israel directly. Now let's look at the global macros picture, especially US. Even after the US elected Donald Trump as the president, because it is now expected that probably the fiscal deficit would be higher, which could lead to higher rates. But the US Federal Reserve believes that policies are still in the making and it will take time for the policies to percolate down to inflation, probably in the next 6 to 12 months. The Chairman Powell also voiced his opinion, saying that they have to wait for what actually comes out apart from the election rhetoric, which has been going on for a couple of months. In terms of growth, US continues to grow strongly at 2.8% for Q3. And inflation numbers also remain sticky, around 2.6%. While the target is 2%, the last few readings have been kind of stuck around 2.5, 2.6% range, which shows that the last mile has been extremely challenging and difficult. In spite of that, the US Federal Reserve is committed to cutting rates to a certain extent so as to bring down the overall rate to a neutral range, because right now they are in a very restrictive zone. We do expect another 25 basis rate cut from the US Federal Reserve in the December policy. After that, one has to wait and see what kind of guidance is given by the US Federal Reserve in terms of forward rate cuts. Market has dialed down the rate cut expectation after the US presidential victory of Donald Trump to about 50 to 75 basis next year. Earlier it was 100 to 125 basis points. That is the reason for the sharp reaction in the US rates. Coming to India, there was a big surprise in macroeconomic numbers. GDP growth rate, which came at 6.7% in Q1, dropped sharply to 5.4% in Q2. This was much below expectations of 6.5%, which was a consensus Bloomberg expectation, and RBI's own expectation of 7.2% for the full year. Now market is expecting overall GDP growth of around 6.5% on the average for the full year. RBI's last expectation, like I said, was 7.2%. RBI's policy is there this week on 6th of December. It will be most likely that RBI will dial down their growth projections to much lower levels, considering the slowdown which has happened in urban consumption and as well in private investments, which has led to lower GDP growth. Coming to inflation, inflation has been surprising on the last two numbers. The last number was 6.2% for October, which is much higher than the 6% upper band of RBI's target range of 4 to 6%. Obviously, with higher inflation and lower growth numbers, RBI will be in a hard seat to determine what to do in the policy which is scheduled in this week. It is expected there will be very robust discussion on whether to manage inflation or growth. Because growth plummeting right now is a worrying sign for the overall health of the economy. Looking at other numbers also, credit growth in the banking sector has slowed down to 11 to 12% from about 16-17% a couple of months ago. That itself shows sign that industry is not borrowing from the banks. Apart from that, RBI did do many regulations on personal loans, unsecured loans, etc., which may have led to slowdown as well. So this policy again would be a very major policy event, as it will determine whether RBI will cut to support growth or will continue to keep rates high to ensure that inflation does not shoot up again in the coming months. While the near-term inflation is expected to trend down in the next couple of readings, RBI will not have that number available before they make that decision. So it will be a toss-up between rate cut and pause. There is expectation that because of liquidity challenges which the current market is facing, RBI may reduce CRR, and also there is a chatter about OMO bond purchases, which will be positive for bond markets. Coming to bond markets have been mirroring US markets in absence of any hard data from the Indian markets except for the inflation number. Our yields also climbed up in line with US yields, but the movement was not so large. Our yields, 10-year yield, government bond yield, 10-year government bond yield went to from about 6.7%, the low which we saw in September, October, to 6.85 in November. Again, these numbers after the GDP numbers which were released on 29th November have again dropped to 670. So there is anticipation, there's a big anticipation that RBI is likely to move on rates sooner rather than later. That is good for bond markets. Bond markets as well as corporate bond markets yields have been coming down in the recent past slowly, but we did see a sharp drop in the last trading session. Going forward, obviously it is RBI policy which will decide how markets move. RBI will have to give something to markets to assure them that the growth is being taken care of apart from managing inflation. From the investor perspective, it is better to stay put on your positions, bond positions. We do anticipate either a liquidity action like a CRR cut or OMO bond purchases, or likely rate cut, which again is a 50-50 chance. As usual, investors should look at their risk and return profile and their investment horizon to invest in debt funds. From a current position with short-term rates on the higher side, there is possibility that the very short curve, which is 3 months to 1 year, which is very steep, but 1 year is the highest rate as of now on the curve. Funds like a low duration fund and ultra short term fund can give superior risk adjusted returns to investors in light of an expectation of rate cut, which is likely to push the short term rate curve faster than a long term rate curve. So we anticipate that the short term curve should do better than the long term curve. Thank you and goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.